Hi everybody, welcome to another video of what's moving the markets. Today we're going to talk about geographical diversification, and in this particular video we will be focusing on two economies that are Turkey and Chile, which are growing faster than many other countries in the world, and their high GDP growth rates are reflecting in their market performance. And if you look at their performance for this past week, they have gained more than 5% each. And we will be comparing that to the US market as well. As always, just a quick disclaimer, this is not investment advice, and please do your own due diligence before taking your investment decisions. Now, as we have been talking about these past few weeks, that the US has been reporting the highest inflation numbers in the past 40 years, right? Previously, we already talked about how from December 2020 to December 2021, the CPI has gone up 7%, and the latest numbers for Jan are out, and they have shown that the CPI has gone up 7.5% from Jan 2021 to Jan 2022. So even the December 7% is now looking small compared to this 7.5% of January. And core inflation has gone up even more, right? So this time the core inflation has gone up 6%, which is of course worrying because the Federal Reserve has a target to keep core inflation around 2%. So 6% is a lot more than 2%. On the other hand, the January jobs report was very good, right? Much higher than expected. And the expectation was 125,000, whereas the actual jobs payrolls, non-farm payrolls, they surged 467,000. So that again is bad for the markets, even though it sounds like it's good news, and it is good news for the economy. But in terms of the Federal Reserve, since it has a dual mandate, that number one, to keep inflation around 2%, and number two, to keep unemployment below 4%, or 4.1 to be exact, they have to keep it approximately below 4.1. So because these new jobs have been created and they are much more than expectation, so the Federal Reserve has room to increase interest rates to control the inflation, right? And the market was hoping that the economic situation wouldn't be that good, so the Fed would not come and increase the interest rate so much. But since the economy is doing well and the Federal Reserve can afford to increase interest rates, and the market, I believe, is expecting around maybe 50% increase in interest rates in the March meeting, and another 5 hikes in the year. But this is just expectation, of course. Nobody knows exactly what's going to happen. But of course, the market is already pricing this in, especially within the growth stocks. And we have seen growth stocks taking a major hit, which is something we have been talking about for weeks now. And we have been telling you that this is expected to happen, right? And one of the things that we said would be a good strategy, which investors are expected to do, is rotating into value stocks. And we have seen that the value stocks are actually going up as well. Secondly, we've talked about diversifying into different asset classes such as commodities, and commodities are going up as well. So that has been proven to play out as per expectations. Today, we're going to talk about geographically diversifying our portfolios. And how should one go about doing that? The analysis starts with the GDP growth rate. But before I get into why it starts with the GDP growth rate, I would like to just talk a little bit about what is the importance of terminal value. And first, I would like to explain what is the terminal value to those of us who don't know. And then I would like to emphasize on the importance of the terminal value. And then I want to go on and link the GDP growth rate with the terminal value so that our viewers can all appreciate that why it is important to look at the GDP growth rate of a country with respect to investing in its stock markets. And then we will have a look at which are the fastest growing economies in the world with respect to their GDP growth rate. And then we will compare how some of their stock markets have been performing this past week. So moving on. So what is the importance of terminal value? First of all, what is the terminal value? The terminal value is the growth rate, or rather the terminal. First, let's talk about what is the terminal growth rate through which the terminal value is calculated. So the terminal growth rate is the constant rate at which we expect a firm's cash flows to grow indefinitely. Now, stocks represent ownership stakes in companies, and companies are expected to have indefinite lives, right? They are not expected to have definite lives, so they can go on till infinity. And if we want to evaluate what is, or if we want to value a company, we will have to kind of predict or forecast or project into infinity what its cash flows will be in order to calculate the present value of those cash flows. But of course, we can't do that because that will be just an ongoing exercise which will never end. So at some point, we have to take an assumption that, okay, so this is the company's current cash flow, or this is what it is going to be at some point in the future. And then from that point onwards, it's just going to grow at a constant rate. So this constant rate is what we call the terminal growth rate. And using that, we calculate the terminal value. So this is the growth rate which is used beyond the forecast period. So you might have a financial model for 5 years or maybe for 10 years, and some companies, especially oil and gas, we see that the companies are having financial models for longer periods, maybe 20 years. But I mean, of course, there is a limit to this, right? You can't keep just adding years on your forecast period because it is a lengthy exercise. And at some point, we will assume that the firm's free cash flow will continue to grow at this constant rate, which we call the terminal growth rate, right? Instead of projecting, so rather than projecting the free cash flow into infinity, so we take this assumption. Now, why is this important? What is the importance of terminal value? So based on this terminal growth rate, the terminal value that we calculate, it has been said that in certain cases, up to 80% of a company's valuation comes from its terminal value. So the valuation that we calculate for a company, majority of it, 80%, or it could be more, could be less, but a huge chunk, its main contribution of a company's valuation is coming from this terminal value. And the terminal value is directly linked to the terminal growth rate. And why is GDP growth rate important? So let's move on and see the link between the GDP growth rate and the terminal value. Now, practically speaking, the terminal growth rates that are taken in these financial models range between the historical inflation rate and the average GDP growth rate. And why that is because if we take a terminal growth rate that is not less than the average growth rate, and let's say if we take a terminal growth rate which is higher than the GDP growth rate, that would be saying that the company expects its growth to be more than that of the economy forever. Now, maybe for a year it could be, maybe for 2 years it could be, but for a company to grow faster than the economy it is in forever is highly unlikely. So this would be a very impractical assumption. This would not be a practical assumption, right? And therefore, the terminal value is calculated using a terminal growth rate which is less than the GDP growth rate, and that is how it should be. Now, that is why it is very important to see what is the GDP growth rate of countries, and the higher the GDP growth rate, the higher the GDP growth rate of a country, the higher you can have the terminal growth rate of its economies, of its companies within that economy. So the higher the GDP growth rate, the higher the terminal growth rate, and the higher the terminal growth rate, the higher the value of companies within that economy, right? So let's look at the fastest growing economies in the world. Let's just look at the top five. So 1, 2, 3, 4, and 5. So we've got India and China, no surprise there. Let me just ignore India and China for the time being, because of course those economies are huge, and China especially. I mean, just look at the size of this economy. It's the second biggest economy in the world now after the US, and they of course are getting a lot of attention. But two economies that I want to talk about, which are not as much in the limelight but are having very, very fast growths, are Turkey and Chile. Relatively smaller economies, and Chile has had 11% growth in 2021, whereas Turkey has had 8.9%, 8.95% growth in 2021. And if we look at the stock market performance and we compare it to the US, so US again has had another volatile week, right, as expected, and the large cap indexes have ended the week lower. And we have been talking about growth companies. So technology heavy Nasdaq, which has a lot of growth companies, has fared the worst, and it has ended the week down, and it's roughly 15% down from its peak. So no surprise there. Again, this is something we have been talking about for 3 weeks, 4 weeks now, and it is as per expectation. Now on the other hand, look at Chile, right? Chile has gone up. The stock market of Chile has gone up about 5.1%. Turkey this past week has gone up 5.5%. So the point I'm trying to make here is that if you would like to diversify your portfolios, in addition to US equities, in which you have added growth companies, value companies, in addition to the growth ones, or you've rotated into value, especially those type of value companies that have good brands and proprietary technology, and they can pass on the inflation impact, and their revenues and profits can be expected to grow. So that's good. Growth is good. Value is good, right? And in addition to value stocks, we also talked about adding commodities to your portfolios, right? Such as agricultural and industrial metals. So we talked about both agricultural, and there is a separate video that we have made on this. If you are interested in more details, please search on the channel for that video, where there is agricultural, commodities, and industrial metals that we have talked about, and how you can efficiently and easily invest in those using ETFs. And today we have talked about geographical diversification, right? In which you can look at the GDP growth rates of different countries and then try and do some research on what are the sectors within those countries and which are good growing companies or good value companies within those economies. So as always, I would like to wish you happy investing and hope to see you in the next video. Thank you very much.